Kia ora, and welcome to the CoreLogic Property Market Update for Mahuru, September 2024. Brought to you by Loan Market. Aotearoa property values continued to fall at winter's end, with the CoreLogic Home Value Index dropping 0.5% in August. That takes the change over the 3 winter months to negative 2.2%, and a total fall of negative 3.7% since February, when values peaked following a mini resurgence in the second half of 2023. However, the significant turnaround in interest rate expectations could be the end of the latest downturn, as affordability and confidence in the property market improves. Last month's monetary policy statement and associated official cash rate decision from the Reserve Bank of New Zealand played a large part in that shift of expectations, as the committee cut the OCR by 25 basis points and significantly revised their forecast for future changes. The rate, which currently sits at 5.25%, could be as low as 4% in a year's time, and see the one-year mortgage interest rate dip below 5.5%, a stark contrast to the heights of 7.3% which were available at the start of 2024. Importantly, this will improve mortgage affordability and any expectations of future capital growth. But before we get too far ahead of ourselves, it's worth reflecting on the latest value movements across the country. The Home Value Index for August illustrated the recent weakness in values was relatively widespread, though more prevalent across Te Ika a Maui, the North Island, than Te Waipunamu, the South. Values were down 1% in Tamaki Makaurau, Auckland, 0.8% in Kirikiriroa, Hamilton, and 0.4% in Tauranga, but increased by a marginal 0.2% in Te Whanganui Atara, Wellington City, and further south in Ōtautahi, Christchurch. Expanding to the rest of our main urban areas, the resilience in Te Waipunamu, the South Island, is also visible, with Waihopai and Vikago values up 0.7% over the month, and Tahuna Queenstown Lakes up 0.5%. Back in Te Ika a Maui, the North Island, the more affordable market of Whanganui did see a 0.7% increase in August. In contrast, values in the Kapiti Coast District, Te Awa Kairangi ki Tai, Lower Hutt City, Te Papaʻioia, Palmerston North, and Whangarei markets fell by 0.6% or more. As we approach another market inflection point, it's an interesting time to take in the broader, longer-term trends. Particularly, it's worth comparing where values were before the most recent property boom, pre-COVID, March 2020. Incredibly, 4.5 years ago now. Aotearoa property values are 17.2% higher than March 2020, which translates to an average of less than 4% growth per year. Over an even longer-term context, that's pretty underwhelming. In Tamaki Makaurau, Auckland, Te Whanganui Atara, Wellington, and Ōtepoti, Dunedin, values are 9 to 10% higher. In Kirikiriroa, Hamilton, and Tauranga, they're 20 to 21% higher. And in Ōtautahi, Christchurch, 41% higher. Those figures are notably different, which can happen through property market cycles, with each city experiencing differing trends in the lead up to COVID, which may have influenced future performance. It therefore doesn't necessarily mean there's any catch-up in store for those with lower growth rates, for example. What it does mean is sellers and buyers will be experiencing quite different sentiment when entering the market. For example, someone in Christchurch who bought pre-COVID may feel much more comfortable listing their property now than an Aucklander or Wellingtonian, who may choose to ride out the downturn, hope for further falls in interest rates to relieve the mortgage payment squeeze, and try their luck in a year or two. There are plenty of other things that will lead to a differing mindset, including whether the owner selling is the occupier or an investor, as well as their employment status. We've noticed a slight pickup in investors listing their property for sale, which might be due to the Bright Line test being shortened at the start of July, potentially eliminating their capital gains tax obligation, as well as higher landlord costs and increased rental supply affecting their bottom line. From a labour market perspective, and looking at the country's economic performance, it's clear businesses and households alike are doing it tough. Hence the need for monetary policy to loosen. The unemployment rate is expected to continue to increase, while Te Whanganui Atara, the Wellington market in particular, is yet to feel the public service cuts in full effect, likely leading to constraints in property demand in the capital. Alongside the vulnerable labour market, still stretched mortgage affordability and high levels of listed for sale supply are likely to keep any genuine market rebound in check, even as falling interest rates will improve affordability. We're starting from historically the toughest levels of affordability, so it'll take time for that to improve. The new debt-to-income restrictions are unlikely to have much impact in the short term, but rough calculations suggest they could kick in once interest rates fall another 1 to 1.5%, perhaps a year away. Maybe more than ever, each data release will have an impact on future expectations. So make sure you follow all our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X or Facebook. Don't forget to download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.